Hey guys, what's up? I'm Erin and welcome back to the channel. Imagine the Fed slashed interest rates all the way down to 1%. What would that mean for your savings, your mortgage, your investments, or even your job? Well, President Donald Trump says that's exactly what the Federal Reserve should do. But economists are calling the idea ludicrous and warning it could actually backfire. So what's really going on here? And what would 1% interest rates really mean for the economy? Let's break it down. President Donald Trump has made it crystal clear. I think we should be paying 1% right now, he told reporters in June 2025. He added, "We're paying more because we have a guy who suffers from Trump derangement syndrome." That guy he's referring to is the Federal Reserve Chair Jerome Powell, and this is someone who Trump appointed to his current position, but now openly criticizes. So why does Trump want such low interest rates? Because lower rates make borrowing cheaper. This fuels economic growth, job creation, and a booming stock market. All pieces of the puzzle that Donald Trump says are part of his economic plan. But here's the catch. Today, current federal funds rate is closer to 4.25 to 4.5%. So slashing rates to 1% would be a massive and highly unusual move outside of a full-blown economic crisis. Jerome Powell sees his job differently. As the chair of the Fed, he has a dual mandate: to keep inflation in check and support maximum employment. He has been very clear. If we loosen policy too soon or too much, we could see inflation come back, he warned earlier this year. He's in a position where he has to make often unpopular decisions because they're necessary, and that very well could mean keeping rates higher for longer. On the surface, a 1% federal funds rate sounds like a dream, right? Lower borrowing costs and cheaper loans, who wouldn't want that? Well, when we zoom out, the picture gets a little bit messier. Yes, there are some people who would benefit, but there's also others, including the broader economy, who could take a hit. So let's walk through what a 1% interest rate would mean across the board. First up, borrowers. They'd win. Lower interest rates on credit cards, auto loans, business lines of credit, even mortgages would dip. There's an obvious upside here. How about savers? This category, not so lucky. That high yield savings account that you have that's currently earning about 4% interest, that might drop to say 0.5%. CDs, money market accounts, same thing. They're going to go to rock bottom rates. And for retirees who keep a significant portion of their cash here, they would feel this. What about investors? Stocks would likely jump, especially growth stocks, and bonds would rally because yields would fall as rates fell. But with time, inflation fears might heat up, and that would send those yields on the bonds up again. Home buyers. This is definitely a category we would need to talk about. Lower mortgage rates might sound like a win, and in a way it is. If mortgage rates come down, it's easier to qualify for a home. But here's the thing, that could also drive up demand, and if we increase demand in a market where inventory is already fairly tight, this could drive up home prices, and this can be a complex situation when so many are already priced out of the market. What about businesses? On paper, it might seem like it makes your business easier to grow and expand. Remember, borrowing costs are cheaper now. But if you're a CEO and suddenly rates went from about 4.5% to 1%, it might be a warning sign. You might be asking yourself, what does the Fed know that I don't? You might be moving into defensive territory. And economist Jeffrey Roach put it perfectly. He said, as a big business owner, if I see rates fall to 1%, I'm thinking, what do you know that I don't? I'm not expanding, I'm getting defensive. How about the government? Well, this would be a big win because now it would be much cheaper to service the national debt. But lowering interest rates so dramatically does make it more enticing to borrow more, and that carries more risks as well. So what about the economy as a whole? You definitely get a short-term boost. Consumers might be willing to spend more, borrowing would get more affordable, so we'd see loans tick upwards, and we'd see those gears towards growth start to go. But if we overdo it, slashing rates to 1%, when the economy is not exactly in crisis, we risk overheating the market and triggering inflation, and then we can start to lose confidence in the market. So yes, a 1% rate might seem like a stimulus button, but it could also be like taking antibiotics when you don't have an infection. Might seem helpful in the short term, but long term it could do more harm than good. Have we seen 1% rates before? Yes, we have, or even lower rates, but only during major economic emergencies. Let's take a brief look. 2003 to 2004, after the dot-com crash, the Fed dropped to 1% to fight off recession. Some say it helped fuel the housing bubble. 2008 through 2015, during the financial crisis, rates went to zero and stayed there for 7 years. It was pure damage control. 2020 through 2022, COVID hit and rates went back to zero to prevent an economic collapse. That also set the stage for the inflation surge we're still dealing with today. A 1% rate is really more break the glass in case of an emergency type of situation. It's not for normal times. It means the Fed is panicking, confidence is low, and the economy is on the brink of life support. So when someone calls for a 1% rate outside of a crisis, it tends to raise some red flags. It's like slamming on the gas when the car doesn't even need it. All right, so let's ground this conversation in where we actually are and where we're likely headed. Right now, the federal funds rate sits around 4.25% to about 4.5%. That's a short-term rate that the Fed uses for short-term loans and dealing with inflation. And it influences just about everything from mortgages to auto loans, credit card rates to business loans, you name it. And as a result, the average 30-year fixed mortgage is hovering right around about 6.75%. And that can be pretty painful for someone who's trying to enter into the housing market. So where are we heading? Well, according to the Fed's own projections, their dot plot, they expect rates to gradually come down to about 3.5% by the end of 2026. That's not exactly cheap credit, but it is a meaningful shift from where we are today. And other analysts are even more optimistic. Morningstar, for example, sees the federal funds rate falling to 2.5 or 3% so long as inflation continues to cool and growth remains modest. And then there's Jay Hatfield, CEO of Infrastructure Capital Advisor. He's one of several voices warning that perhaps the Fed is too tight right now. He put it simply, a 2.75% or 3% rate may support growth without fueling inflation. But today's 5% plus level could cause a recession. In his view, the Fed doesn't need to reduce rates all the way to 1%, but he's concerned that keeping rates too high for too long could lead us towards a recession. Keeping borrowing costs high reduces hiring, it reduces investments, and in the long term, it could tip us into a slowdown. That's why he sees a federal funds rate like 2.75% or 3% as more ideal. It would still support economic growth without stoking inflation. Hopefully. So, do we have cuts in our future? Of course we do. When and how much will happen? Well, I guess only time will tell. But that 1%, that's not even close to a mainstream forecast, unless we enter a full-blown crisis. How does the economy look right now? Where do things actually stand? Let's start with inflation. It's been cooling, and that's the good news, but it still sits above the Fed's target of 2%. So we're going the right direction, we're just not there yet. Unemployment is still low, but we are starting to see some soft spots. Some industries are slower to hire, or some industries are making trims, so it is something we want to keep an eye on to see if this marks a broader shift in the labor force. GDP growth has been decent. Not booming, not crashing, but we're definitely starting to see momentum slow. A lot of analysts are watching Q3 and Q4 closely to see if we dip below trend. Housing affordability still remains a huge issue. We're seeing a slow in the rate at which housing prices are increasing, but house prices themselves remain high, coupled with higher than we're used to interest rates, and this can really make housing affordability out of reach for many people. And then there's the federal debt, which has officially crossed the $34 trillion line. And as rates stay higher, this debt gets more expensive to service, and inevitably it crowds out other budget line items. So all of this is to say, the Fed is in a really tough spot. If they cut rates too aggressively, that risks pushing inflation back up. But if they keep rates too high for too long, that risks slowing down the economy. It's a tough balancing act with very real consequences. So could Trump force the Fed to go to 1% interest rates? Unlikely, and even though Trump has said that he's upset with Powell, could he fire him? Well, he can't really fire him without cause, and this is really how the Federal Reserve is designed. It's designed to be independent so they don't succumb to political pressures. So what we can expect is a gradual easing over time. Maybe we'll see rates get down to 3.5% or even lower by the end of 2026. It's gradual, and it'll only happen if inflation stays under control. This might mean mortgage rates would ease to 5.5% or 6%. Stocks might remain stable or even increase. Savers will still lag behind as interest rates would come down on these guaranteed accounts. It won't be rocket fuel for the economy like 2020 was, but quite frankly, that's probably a good thing because when rates fall too far too fast, well, the long-term consequences can be far worse than the short-term gains. So what are your thoughts on interest rates? How fast and how far do you think they should come down? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.